I would like to thank the organizers and also the sponsors of this conference for the opportunity to speak in front of such a distinguished audience. In some ways, my presentation here continues where we just finished off in the previous section. I will speak about the externalities of financial crisis. Now, the context here in this session is a little bit different, though. We are speaking about the global financial architecture. So what I want to do is I want to look especially at the experience of emerging market financial crisis and derive some conclusions from that on how we should think about the optimal structure of our global financial system. So, for some reason I can't switch to the next slide. Okay, so I want to start off with a historical diagram that I have borrowed from my colleague Carmen Reinhardt. It lasts for the past 208 years, and what it basically depicts is, if you look at the red line, it depicts an indicator of capital mobility, and if you look at the blue line, it depicts the global incidence of financial crisis, here because of data availability, as measured by banking crisis. Now, what we can see here is there is actually a fairly close correlation between the incidence of crisis and capital mobility. So what this suggests is that countries that are integrated into global financial markets are more prone to boom-bust cycles and systemic financial crisis than other countries. So the main question that I want to focus on is this boom-bust pattern of international capital flows socially efficient? And if not, what remedies can we take? The approach that I'm taking in my presentation is in some ways very conventional, following standard economic procedures. So if we are wary of international capital flows because of crisis, I think the natural and straightforward thing to do is to analyze the desirability of free capital flows in our best models of financial crisis. So if we go through a brief history of financial crisis models in emerging market economies, what we find is that earlier generations of crisis models, like the first generation models of Krugman, Flood, and Garber, the second generation models of Obstfeld, or third generation models in the beginning, all essentially lay the blame for financial crisis at distorted government policies. That leads to a very simple conclusion. If only the government could fix its policy distortions, then everything would be fine. But we should basically not touch the structure of the global financial system. In some ways, the East Asian crisis has forced a rethink of this pattern. At the center of the East Asian crisis were very strong balance sheet problems. I don't want to say that the other factors were completely unimportant, but I believe the balance sheet factors were really the primary component of these crises, and they led to very strong systemic amplification effects. So we have seen graphs similar to this one already a number of times in the past 1.5 days. If we have such a systemic financial crisis, a feedback loop takes place, basically between declining aggregate demand to falling exchange rates in the case of open economies, to deteriorating balance sheets because borrowers often have borrowed in particular in dollar-denominated debts, and deteriorating balance sheets force corporations to cut back on investment and spending, which further deteriorates aggregate demand and basically the amplification goes on and on and on and on. Now, it is easy to see the parallel of this form of debt deflation or financial amplification to the forms that we have discussed earlier today playing out in the financial system of, for example, the US or the UK economy. In both cases, there is essentially an asset price involved, or a relative price, like here the exchange rate in models of domestic financial crisis. It is usually a general asset price. And as these asset prices decline, they wreak havoc with balance sheets and lead to further contractions in borrowing ability, and so on and so forth. So in well-functioning markets, in those that are described, for example, by a neoclassical setup, the response of prices to such shocks would be socially efficient. For example, in a small open economy, if aggregate demand declines, the depreciation of the exchange rate is just a mechanism through which aggregate demand gets reallocated towards more local goods. So if the exchange rate declines, it makes it easier to export, and that's a basic equilibrating mechanism. It's essentially a stabilizing force, and it is essential for the functioning of the market economy. Now, in the standard efficient market setup, prices always correctly reflect scarcity. So these price movements, and in economic theory we call them pecuniary externalities, when agents' actions entail price movements, they are essential for the proper functioning of the economy. Now, if we are in a financial crisis, like think the East Asian crisis, exchange rates play a dual role. They not only shift expenditure towards local goods, but they also have this adverse effect on balance sheets. Essentially, as the exchange rate declines, financial constraints across the economy are tightened. That has contractionary effects, and that becomes a destabilizing force, which directly leads to the feedback loop that I have illustrated before. So, the market forces in such an economy drive the exchange rate towards the level where the first role of basically clearing the market is fulfilled, but the market prices don't reflect the social cost of the feedback loop. And as I will argue, that is the primary problem that leads to externalities during crisis. So what do rational private market participants in an economy subject to such feedback loops do? Well, it is rational for small agents to take prices as given, here in this model to take the exchange rate as given. So that means in particular that they don't internalize the price effects of their actions and the resulting balance sheet effects, which leads to these negative externalities across the economy. Now, the primary manifestation of this externality is that private agents undervalue the benefits of holding additional liquidity, of holding additional wealth during crisis. So the rationale for that is, again, as I discussed in the previous slide, that liquidity in such a setup with amplification effects is not only privately beneficial to its owner, but it also mitigates the decline in aggregate demand, mitigates the exchange rate depreciation, and improves balance sheets across the economy, which relaxes financial constraints on everybody. So it means having additional liquidity creates positive financial amplification effects, or positive feedback loops, and for that reason, a social planner values liquidity more highly than private agents would. So I can depict that in a very simple diagram. We have a vertical line here which indicates when financial constraints become binding, and to the right of that line, constraints are loose. To the left of that line, balance sheet effects are active, and the worse the shock that the economy experiences, the stronger the balance sheet effects, and as a result, the greater the divergence between the private and the social valuation of liquidity. Now, in some ways, these graphs simply reflect the pricing kernel of agents. And we know that the pricing kernel in our economic models plays a really central role because it allocates all intertemporal decisions and all risk allocations in the economy. So if this pricing kernel is distorted, if this valuation of payoffs is distorted, then a whole range of actions by private agents in this economy are also distorted. So the first one, on which I want to focus a bit more later, is the allocation of risk in the economy. Agents will take on too much risk or too little insurance against such systemic crisis states. They will also take on too much finance in total because they undervalue the cost of payoffs during such constrained states. Thank you. They will engage in an excessively short maturity structure because longer maturity would ensure. They engage in an inefficient degree of integration. They will engage insufficiently in actions that raise emergency liquidity, and they will also invest excessively in pro-cyclical projects and too little in counter-cyclical projects, again, because they misvalue the social benefit of having profits in those severely constrained states when amplification effects arise. So in a way, this model provides a unified theory of crisis and of the private exposure to crisis. So I was just given a signal. I don't have much time. Let me maybe choose a few topics from the following slides. If we want to think about policy measures to mitigate this externality, a first best measure would be to interrupt the feedback, because we know that the feedback loop is what creates the externality. Now, what I can show in my work is if we do that, for example, by alleviating balance sheet constraints through transfers, then it creates severe moral hazard problems. Under some particular assumptions, any bailout action will actually be fully undone by private agents. So what I therefore want to argue is that it is essential to change the marginal incentives of private agents. So to realign the private and social incentives for taking liquidity precautions, taking a sufficiently low level of risk. That means policy should try to discourage any actions that raise the risk of balance sheet effects, that raise the risks of binding constraints in the economy and of amplification, and encourage actions that mitigate constraints. And by doing so, policymakers can reduce the incidence of constraints and lower volatility and raise welfare for everybody in the economy, since this is an externality. A side remark, some people speak of a trade-off between growth and stability that is faced by regulators, but in an externality framework like this one, the trade-off is actually fictitious. Good regulation can increase both stability and efficiency, or growth if you want, because basically the free market equilibrium is inside the Pareto frontier. Now I want to illustrate, I want to give you one example of a particular policy measure that can be motivated on the basis of this externality. And what I have done here is I have essentially used the financial crisis in Indonesia as a case study to measure the magnitude of externalities that can be caused during a financial crisis, and to measure how different forms of finance, different forms of liabilities would differ in the externalities that they impose. So in this table, you can see that the real gross return for private borrowers in Indonesia that had taken on dollar debt in 97 and had to repay it in 98 was 218%. And every dollar imposed an externality on the economy that had a pecuniary value of 30 cents. So that's really a significant externality. Now, if we believe that a crisis arises, like here in my sample, every 20 years, that would justify a tax on taking on dollar debt in the magnitude of 1.54%. If we go down this list here, we can see that different forms of liability have different riskiness. So, for example, CPI-indexed debt will have significantly lower payoffs than dollar debt because the exchange rate and even the real exchange rate depreciated. Rupiah debt depreciated even more because the exchange rate fell and inflation rose. And an investment into, for example, the stock market index allowed for even greater risk sharing and therefore had even lower externalities. Now, in the remaining minute of my presentation, I want to focus more on the general global environment that is conducive to such externalities. And I think one of the important elements that raise the incidence of such externalities and raise the risk of financial fragility is basically low global interest rates. So in this category of models, it can be shown that in a low interest environment, leverage is naturally cheaper, and that increases the incentives of private agents to take on greater systemic risk. And that naturally leads to greater financial fragility and also to greater systemic externalities. In fact, there is a convex relationship. So the more we lower interest rates, the stronger the effect on the externalities is. Now, this suggests that low interest rates and stronger regulations are very complementary. Whenever interest rates are low in the global economy, the importance of these externalities is particularly severe. Now, there are two examples which lead to low interest rates in the current economic environment. One of them is the significant amount of reserve accumulations for reasons that were already discussed in the previous session across the world economy, which pushes down interest rates. And the second, and I think somewhat underemphasized reason, is that financial constraints in a large part of the economy, basically all Western countries, are very tight, and the capacity of agents across the Western economies to take on more debt is severely limited, except maybe for some of the governments. Now, that means the capital has to go somewhere else. And what we can see nowadays is that it is flowing vehemently into emerging market economies. So I think in the current economic environment, there is a great risk that these capital flows will increase the financial fragility of emerging market economies. And that should really be a strong call for more regulation of capital inflows. So to conclude, what I wanted to emphasize in my presentation here today is that financial crises with feedback loops always entail externalities. These externalities distort the risk-taking decisions of the private sector towards taking on excessive systemic risk. And as a result, the macroeconomic outcome is excessively volatile. But proper policy action can raise both stability and economic growth. Thank you.